Hi, friends. Professor Joe here. I hope you all are doing great. Welcome to this video. Now, in this video, we are going to discuss why averaging is one of the best strategy to make consistent profit. Now, I know it might sound controversial, especially for people who are doing trading, but let me tell you, this is what the big investors do to make consistent profit from the stock markets. Before we go ahead, friends, if you have not subscribed to my channel, please subscribe to my channel and ring the bell icon. I keep creating a lot of educational videos on trading, stocks, crypto, options, and many other related topics. If you are subscribed to my channel, you will be the first person to be notified every single time I create a new video. Let's get back to our topic. Why is averaging told to be the best strategy to make consistent profits from the stock markets? So, before we go ahead, what is more important is to understand what is averaging. So, here is a definition of averaging in action. Imagine an investor has bought a stock at a certain price. If the stock's price fall after the purchase, the investors buy more of the same stock instead of panicking or selling it off. By doing this, the average price they have paid for the stock gets adjusted. So, what exactly does this mean? So, let us look at a small drawing and understand what exactly it means. So, for example, you are an investor, you bought a stock at this level over here. The price probably went a little bit up and then came back down and came to this level. So, say, example, at level 1, you have invested, say, 2% of your equity. At level 2, you invested 5% of your equity. The stock price continued going down. And then you invested at the third level around another 7% of your equity. The price continued even further down. Then you invested another 10% of your equity at level 4. The price continued down. And at that level, you invested another 15% of your equity. So total you have invested 2 plus 5 plus 7 plus 10 plus 15. And when the price goes back up, so at level 1, your 15% in investment is in profit. So there you're earning about, say, it's gone around 3 times. So you're made around 45% profit. But when the price goes up, then your 10% is also in profit, your 7% is also in profit, and your 5% is at break even. So this way, everything put together, you will be on a profit of around 70 to 80%. This is how you make profit in averaging. But every single person who is averaging should remember that averaging is a strategy. Averaging is not a quick fix scheme wherein you enter into an intraday trade and then you see that the trade is going against you and then you want to average that trade. That is not how it is going to work. Because of the drawdown, the 50% of the margin is used up. The rest 50% the trader will enter. And then if the trade continues going against the trader's account is wiped out. So intraday trade cannot be converted into a averaging strategy. That is where a lot of people fail while using averaging. So for an intraday trader, it is always best to exit with the stop loss. Averaging for an intraday trader is dangerous. Their account can get wiped out. So averaging is a strategy. You have to understand that. When you're averaging, you need to understand which financial instrument you're going to use your averaging strategy. Averaging strategy cannot be used on individual stocks. Yes, individual stock gives the maximum profit when it starts trending in the right direction. Yes, there were some stocks which were doing extremely well, but because of its mismanagement or because of new inventions that happened in the world, these stocks then started falling. Once upon a time, Nokia was considered to be the best stock. I still remember fund managers used to say that Nokia is a stock which can be used for your retirement purpose. Here, I'm still not retired. At the same time, Nokia stock has fallen by 95%. Enron, that Enron is a stock on which the sun never sets because Enron had business all across the globe. And look at it, what is the situation today? Enron has been totally delisted from the stock markets. So when it comes to individual stocks, averaging can get risky because if the stock price falls because of any problem, all your hard earned money will be gone. So then where do we use averaging? At the same time, you cannot use averaging in currency pairs also. Currency pairs also can be dangerous. Although currency market is a fluctuating market, but sometimes the fall can be so steep that the currency pair market can lose 3,000, 4,000 points. For example, what happened during the Greece crisis between Euro USD? You can see in the charts. It's a monthly chart. Continuous 12 months, the price kept falling. Continuous. 3,000, almost 3,500 points. Right from 1.3992, it came to 1.0493. And you can see all the monthly candles are red in color. Now just imagine if a trader would have entered in that second green candle over there and then tried to average down. Probably half the way, the trader would have lost their entire equity. Now, yes, the institutions do trade in the opposite direction of the trend, but they have extremely, extremely deep pockets. They have the money to hold on to those trades. But what about retail traders? They do not have the capacity. So it is very, very dangerous to use averaging strategy even in a currency pair. You can use averaging, but then the strategy has to be very, very clear in your mind. But which is the best place to do averaging? The best place to do averaging is the index. Yes. Why index? You pick up an index of a growing economy. When I say growing economy, an economy where there is production happening and where there is consumption happening. Why? Because wherever production is happening, there is employment. And when there is employment, people are getting salaries. And if people are getting salaries, they are going to consume. So any economy where there is production and consumption will grow over a period of time. Let us take two examples. One, the S&P 500, the index in US. And let us take Nifty 50, the index in India. If you look at the charts for both these indexes, you will see in the last 25 years, the price has continuously grown, except for two times. One, during the 2008 subprime crisis, where there was a global financial crisis, you can see that the prices came down almost up to 50%. And then in 2020, during the coronavirus period, where the prices fell by 25%. But other than that, there has been ups and downs, ups and downs, ups and downs, and the prices have continuously gone up. But what is more important about the indexes? The index is a accumulation of multiple companies which are best in their sector. And every 6 months, these companies are reviewed. So, for sake of discussion, if there was one company, say Nokia was in the index, but because of some reason now Nokia company is not performing. So, what will happen is if you have invested individually in Nokia company, you will have to face the loss. But if you are invested in the index, the review committee will remove Nokia, take it out because now it's a bad company and put a better performing company in that place. So now what has happened? A non-performing company has gone out and a performing company has come back into the index, into the cumulative stocks of index. So all the stocks that are there in the index are those stocks which are performing in their individual sectors, even in adverse conditions. So that is the reason when the economy is growing, the index will also keep growing. And the bad companies which are not performing well because of whichever reasons, they will come out and the better companies will come in. So that is the second reason why you should be investing in an index if you are using averaging as a strategy to make money from the stock markets. So whenever you start investing, say example, you are investing, you invested, the price went up, great. You don't have to worry. You're making your profit. Your problem starts when the price starts coming down. So when the price starts coming down, you use the same averaging strategy which we explained in the start. You always start with 2% of your equity or whichever you want. but you start with very small percentage of your equity. And then when the price goes against you, you infuse a little bit more than what you have infused earlier. So in our example, we took 2%, then we took 5%, then we took 7%, then we took 10%, and then we took 15%. Now, every single time that you're entering, you have to make sure that that is a good support area and the prices have turned from those areas. So you have to plan every single entry. Averaging strategy is a well planned strategy. It is just not a strategy that comes out of the blue. Great investors use averaging strategy to make consistent money from the stock markets. Now, remember, friends, whether it is averaging strategy or whether it is any other strategy, you have to spend time in the markets. You need to have a lot of patience. You need to practice. You need to be persistent. All these three things are equally important if you really want to make money in the financial markets. It doesn't happen overnight. You'll have to learn, you'll have to plan, and then you have to infuse. So I hope that this video has made it very, very clear that averaging strategy is the best strategy to make consistent return from the stock markets. But there are some conditions that apply to it. You have to make sure that these conditions are adhered to if you want to use averaging strategy. Friends, if you love the way I'm creating content, please like and share these videos. So, like you, there might be many others who are interested in learning trading the right way. These videos will surely help them to improve their standard in trade. Friends, I've created a lot of videos and I'll be creating many more videos in the future. If you're still not subscribed to my channel, please subscribe to the channel and ring the bell icon so that every time I create a new video and post it on YouTube, you will be the first person to be notified. Friends, all I can say is keep learning, keep growing. But before I sign out, I just want to tell you that I have created a trading training series of videos and the link has been put down here. Kindly go through those videos. It will surely help you to become a better and a consistent, profitable trader. Thank you. Namaskar.